Hi there, and welcome to this lecture on the duration model for Banking Risk 2. Before watching this presentation, you should have a very good understanding of bond pricing and have viewed the first part of the lecture recording where I go through the duration model and modified duration in Excel to give you a better understanding of what we're looking for in Macaulay's duration and modified duration. Watching that in Excel will give you a better and more easier understanding of the text throughout this presentation. So this presentation covers these concepts. Again, we explain and analyse the duration model, specifically Macaulay's duration. Then we look at price sensitivity using modified duration. We briefly cover the concept of convexity as a limitation to the duration model. And in the last part, we'll explain the concept of balance sheet immunization when we look at the duration gap on a bank's balance sheet and how an interest rate rise can impact regulatory capital on the liability side of the balance sheet. So, Macaulay's duration. Just like the part 1, it's working out the average time it takes for cashback to be received on a weighting basis, specifically for fixed income. If you're risk averse, whether that be an investor or risk appetite from bank's management, then the lower the duration, the better. If we go back to the previous model, the maturity model, any product that is longer dated, the price swings further. This is also the same for longer durations. What you note at the bottom of this slide, more importantly, is the duration model is preferred by the Bank of International Settlement as the measurement for interest rate risk. And this is because it combines both cash flow and economic value. So the repricing model is more about net interest income, profitability and cash flow. The maturity model is more about economic value. But duration tries to combine both cash flow and economic value in the same calculation, thus being preferred by the BIS. So let's jump into an example. And in this case, I'm going to give you an example of an asset. So bear in mind what we covered in the Excel spreadsheet. This is very similar, but just a different example and in text rather than in Excel. So we have an example of an asset that pays £50 plus interest in 2 payments over the year. So the principal being 100. As you can see, the first cash flow is £50 principal plus the interest. The second cash flow again, £50 plus the interest. Obviously the interest is slightly lower this time because it's based on £50 rather than 100, which the 6-month interest would have been. So 6 months we receive £57.50, 1 year £53.75. Given the current discount factor, we're using the interest rate of 15% here. Discount that back to a day, then we work out the present value of this asset. As you can see here, given that the interest rate and the discount factor were assumed as the same, thus the asset is currently valued at £100. Now when we do the duration, as you know, we need to wait when that payment is to be received by the amount of the payment, which is already discounted, using the duration formula. And in this instance, because the first payment has a higher weighting because it's the larger sum of money, that equates to 53.49 of what the investor in this asset receives. Then later on, the extra 46.51% is the second payment. And if we combine the payment weighting by when the time horizon is received, then we work out the duration of this 1 year loan is 0.7326. Now that makes sense if we go back to the concept of the seesaw in part 1. Because you've got a year-long product, the majority of the payment is actually half after 6 months rather than the year. Then we'd expect the duration to be closer to half a year than 1 year. So the duration for this 1 year product, what pays 2 payments, is 0.7326 of a year. Let's look at another example now. So we have a liability. that funds this asset. And same characteristics, principal 100, interest rate at 15%, but this time, because it's a certificate of deposit, all the interest is literally paid at the end. If we discount that back to today, lo and behold, the principal is obviously 100, discounted also 100, and if you're thinking ahead, because it's all paid at the end, there's no cash flows before that, then of course the duration of this liability is just going to be 1, as highlighted in this slide here and confirmed on this slide. So we had an asset and a liability, they both had 1 year, but the payment schedule was very different. So if we'd applied the maturity model to this example, then they were both 1 year long. Thus the maturity gap would be 0. Now if you remember, in the last week's lecture, we acknowledged the limitation of the maturity model is it doesn't take into account any of the timings of the cash flow. But doing this approach, using the duration model, we've seen that the duration of the loan on the asset side is actually less than the duration on the liability side. There is actually a duration gap of minus 0.2674 because the duration is calculated by duration of the asset minus the duration of the liability. This concept, the duration model, was created by Frederick Macaulay, and it was actually back in 1938, and it was originally designed in research for the volatility of fixed income products. Hence why most of the examples I use in Excel, I use the likes of a bond as a fixed income. So typically this model is applied to fixed income products. It can be applied to variable products, but when we apply it to variable products, when we create the cash flow schedule, we're assuming the interest rate doesn't change. Thus, if interest rate did change, then the cash flow schedule would change and we'd have to do the model all over again. So this model is much easier applied to a cash flow schedule that we already know and we can predict, thus fixed income. And if you ever want to example your understanding of duration, it would be best to do it on a fixed income product. In part 1, we highlighted a number of the rules for duration, but again, in a recap in text here, obviously the longer the maturity of the fixed income product, that's obviously going to expand the length of duration. With any fixed income product, if the cash flows are quite large, like the coupon payments, then that's going to bring back the duration length. If the coupon payments are very low, then that's going to push out duration towards the final payment. And obviously, if the maturity is much greater, then going back to what we learned last time, the price sensitivity, when we start to think about that, the price sensitivity is going to be much higher. The longer it is, the more the discount we have to do for the present value, for instance. So of course, when payments are to be received much later, then that's going to really push out the duration number in years. If we want to look at the formula rather than the Excel spreadsheet of how you calculate Macaulay's duration, then this is what it looks like. And what you'll be quite familiar with is the bottom half, cash flows times the discount factors in time. Essentially the bottom half is the price. So the price of the bond, for instance. But the top half is the Macaulay duration bit. This is where you have the cash flow times the discount factor, which is weighted at the time period of when that payment's received. So if you go back to the Excel spreadsheet, we had the formula where this is the price, when we calculate the price of the bond. This was then used as we divided the Macaulay duration bit by the price. And this slide here, this formula, also highlights the fact that this can just be simplified into the present values at the times weighted times by when they arrive divided by the price. So this formula is something that you find rather confusing to look at. Just go back to the Excel spreadsheet and work out by the steps on how we calculated it to understand how you do it, but this is how you mathematically represent it. And if you were to work this out by hand, we've got an example here for you. So in this case, we have a 2-year redeemable bond. The coupon's 15%, but in this case, we're already told the price at 108.34. And we're given the discount factor, or the yield, at 10%. So in order to work out the duration, we already know P. It's told in the question. So what we need to do is work out the present values of the cash flows and times them by when they arrive. So given it's a £100 redeemable bond, we know that the cash flow, the coupon, which is annual, is the assumption, is going to be at the end of year 1, you get £15. At the end of year 2, you get £15 plus the principal of £100. To work out PV, we have £15 discounted back to today. So £15 we receive in a year's time. Today is worth £13.64. But for the second year, remember, because we have the T here, we have to times it all by 2. So we discount the cash flows that we receive in 2 years' time. Well, after we do that discounting, then we times it by 2, as we did in the Excel spreadsheet. So the top half totals 203.72. And to work out the Macaulay's duration is we divide this 203.72 by the price. Thus the duration of this 2-year bond, which has 2 cash flow payments, is 1.88. And again, that makes sense because this is a 2-year product, with the largest payment being at the 2 years and only a small £15 in this case being paid at the end of the first year. Given that seesaw or centre of gravity example, then we know that the duration is going to be closer to 2 than it is to 1. In the red here, we've just got a bit more of the mathematics to help you understand it in more detail. We can now extend this formula, if you like, to an example where we have a bond that would pay semi-annually. So when we have more coupons, then of course we're going to have to actually incorporate the fact that you've got semi-annual payments, and then this way you have the likes of the simple interest, which would be divided by 2 across 2 payment schedules. You can read more about the mathematics in your core textbooks or wherever you get your duration model knowledge from to understand how this formula works, and if you want to practice it mathematically, please feel free to do so. But also in the seminar for this week, we will go through a real example of a bond which pays semi-annual in Excel. So as we noted earlier on, what this actually tells us is the average lifetime of the cash flows of this product. And we can work out time in years for the weighted average time for cash flows to be received. And this is really used for comparison purposes. If you were an investor, you would look at the duration of the different bonds that might have very different characteristics, but at least with duration, it kind of gives you a reference point to help compare between bonds. And you could also, as noted in part 1, you could use the duration, time in years, to work out an equivalent zero coupon bond for comparison purposes. But what we can use it for is we can look at a bank's balance sheet, and when we can look at the duration of the assets relative to the duration of the liabilities, and then work out by minusing assets duration minus liability duration, we can work out the duration gap of the balance sheet. And that's useful. However, what banks would prefer to use it for is really the concept of modified duration. And this is where we can change that time in years to work out price sensitivity. And similar to part 1, we use this formula where we have Macaulay's duration divided by 1 plus the yield to maturity divided by the number of cash flows or discount periods in a year. So obviously 2 would be semi-annual, but if it was just an annual payment, N would be 1. And the purpose of this is, as I mentioned, price sensitivity. Essentially, if interest rates change, how does that actually impact the price of the asset or liability under observation? So if we go back to the example we did a couple of slides ago, where we worked out that this 2-year redeemable bond had a duration of 1.88. Well, if we modify that using this formula, then the modified duration is 1.71. Now, first thing to note here is that modified duration will always be lower than the Macaulay's duration, with the assumption that yield to maturity is always positive. In the unlikely event that yield to maturity is negative, which in real life can practically happen if there is a case of negative interest rates, then modified duration will always be lower than actual Macaulay's duration. But what does this 1.71 actually mean? Well, in simple terms, it is price sensitivity. If interest rates in the market go up by 1%, then the price of this asset or liability should go down by 1.71%. So essentially it's used for percentage change. Obviously on the flip side, if interest rates go down, the price will go up by 1.71. Given this example, using simple price change formula, as you can see on the red there, because the price of this product in the question was 108.34, then we simply apply percentage change from 108.34. We increase that by 1.71% or decrease it by 1.71% and work out the equivalent prices. So if interest rates were to go up, then the bond price would fall to 106.49. So this is a real useful tool when it comes to fixed assets, and it gives banks some sort of guidance to see if their overall assets would change relative to interest rate change. So it's a really good proxy. Now I'm saying it's a really good proxy because with modified duration, we worked out or assumed that the relationship between bond prices and yield to maturities is a straight line, and modified duration is the gradient or the slope, in this case of the orange line. But however, in reality, the relationship between bond prices and yield to maturity is actually concave. It's not a straight line. So this is the concept of convexity. Modified duration is a good proxy using a straight line relationship, but the relationship is actually more curved than that. So when we work out price sensitivity with this technique, it's a good proxy, meaning it's not 100% accurate because the relationship actually is curved. If we want to work out the actual curve, then this can only be really observed over time. So see how much an actual bond would change for a change in yield to maturity in real time. So this can only really be observed over a longer period. If you do read your core textbooks, there is actually an additional formula we can use to correct modified duration to take into account convexity. So we can slightly modify and correct modified duration to take into account of this curvature. This curvature is more pronounced for longer dated products, as mentioned plenty of times before and in last week's lecture. The longer the bond, the more the price sensitive, thus the curvature is more pronounced. Another factor is also that interest rates going down have a greater impact on price than if interest rates were to go up. And this was noted as one of the rules relative to the maturity month we covered in last week's lecture. Now let's look at another example where we can compare three assets that have very similar characteristics to see how duration and price sensitivity impacts all three. So again, we have products with a maturity of 2 years each, same principal and the same interest rate. So if we're using the maturity model would say all assets are 2 years. But let's look at duration, given the different payment schedules. So the first asset gives you an equal payment at the end of the first year and the end of the second year. Asset number 2 gives you a 3% coupon at the end of the first year, then the rest at the end of year 2. So the final coupon plus the par value. But asset number 3 is a discounted loan which just has a single payment at the end of the 2 years. So thinking ahead already, asset number 3, the duration, because it's all the end, is just going to be 2 years. Asset number 2, you're only going to get a small amount at the end of the first year and a very large amount at the end of the second year. Therefore, the duration is going to be very close to 2. With asset 1, because it's 2 equal payments, given the discount factor, we're going to kind of gauge the centre of gravity is going to be close to and just under 1.5. So let's break this down a little bit further to go through the maths. We can see here the payment schedule, put in a table for you. So as I said, asset 1, you've got the principal and the interest, which totals the payment outlined on the first slide, and similar to the end of the second year. Asset 2 gives you the coupon, the end of year 1, then the coupon and the par value. Asset number 3 doesn't pay anything in the first year, and gives you all at the end of year 2. So that's just breaking down the payment schedules for us. Then you can practice the maths in your own time if you'd like, but as speculated before, we've worked out that the duration of the first asset is 1.49. The second asset's duration, very close to 2, but it's not 2 because we did receive something at the end of the first year. And of course, asset number 3, the duration's 2 years because everything's received at the end. Now, if we correct this for price sensitivity, we can see that modified duration for all 3 is slightly lower. And yes, even though asset 3, everything's received at the end of the second year, the modified duration, because of the formula, has the yield to maturity in it, it will be slightly less than 2. Therefore, if we say that interest rates go up by 1% in the market, these asset prices should drop. And what we can see here, if interest rates go up by 1%, the drop from 1,000, asset 3 drops the most, closely followed by the second asset. But you can see the price drop for asset 1 was not as severe because it takes into effect the cash flow, that half is given at the end of year 1 and the rest is given at the end, thus highlighting that cash flow payments is also a critical factor regarding price sensitivity when it comes to duration and modified duration. And to conclude, what we've just went through is that duration is preferred by the BIS because it takes into account cash flow timing as well as economic value, unlike the repricing and the maturity model. We've seen that we can correct Macaulay's duration to take into account price sensitivity, and it's this price sensitivity that is actually useful for the banks when we scale that up to the whole balance sheet, which we'll do in the next part. And this concludes this part. Hello and welcome to the final part of this lecture on the duration model. In this part, I'm going to explain the concept of balance sheet immunization and demonstrate how an interest rate change can impact equity using price sensitivity, modified duration. So if you remember from lecture 1, when we give the example of a balance sheet, on one side we have assets, on the other side we have liabilities and ownership equity. Given the typical balance sheet, assets tend to be longer than liabilities. Thus, if we use the duration model and duration of assets is longer than the duration of liabilities, then given what we've learned so far, the price of assets is more price sensitive to interest rate change. So if interest rates were to go up, assets prices would fall much further than the prices of liabilities in this case. And because a balance sheet has to balance, the thing that gets squeezed is ownership equity. Let's have a look at an example and compare that with the maturity model. So here's a simple balance sheet that just has a single asset and a single liability. The asset is a 2-year coupon bond, while the liability being a 2-year certificate of deposit. And let's suppose the 2-year coupon bond, it pays a coupon at the end of the first year, and then the coupon and par value at the end, while the certificate of deposit just pays the payment at the end. Therefore, the asset, in this case, has a lower duration than the liability. The asset is 1.8 years, and the liability is 2 years. So in this case, we'd have a negative gap, because the liabilities are longer than the assets in duration. But if we use the maturity model and apply the same technique as we learned in last week's lecture, then in this case, the balance sheet gap would be 0. It would be immunized. But clearly, because we take into account cash flow in the duration model, then it isn't immunized. The liabilities will then have a greater interest rate sensitivity than the assets, thus the negative gap. If interest rates were to go up, for instance, the net interest income would fall because we'd end up paying more out on the liabilities than the asset, given the asset is typically a fixed product here, given it being a bond. But in this example, equity value will actually rise because the asset value will drop, but the liability value will drop much more because it has a greater price sensitivity. And it's this concept of ownership equity that ourselves and regulators are more interested in. Because if we rearrange the balance sheet formula, if we move ownership equity to the other side, then the equation is assets minus liabilities. Thus, we can work out for any given change in the asset and liabilities value using modified duration, then this will reflect any change in ownership equity. Now, with this concept in mind, and we have the size of the balance sheet, and we can potentially work out the duration of the balance sheet, asset and liabilities, then we can go ahead and simulate how much the balance sheet would change, consequently how much equity would change given an interest rate change. Now let's look at this in a formula. Initially, don't be put off with the size of the formula. If we look at this side of the formula first, this is really related to the balance sheet. And then we times this by the change in the interest rate, taking into account the yield to maturity. So on this side, we have the duration of the assets times the size of the assets overall minus the duration of the liabilities times the total liabilities overall. And this essentially works out the duration gap on the balance sheet. We times that by the correction in interest rates. But we can expand this formula further. And what we can do is we can rearrange the formula and include leverage in the formula here, K. And we know the leverage formula is simply liabilities over assets. Thus, we can simulate the balance sheet better. And if we remember, one of the disadvantages of the maturity model as well was it didn't take into account leverage. However, we can here. So to summarize this formula, we can now take into account leverage in the duration gap. Obviously, the higher the leverage, this may multiply the duration effect on the gap. Because we have the assets and liabilities in total, we're really taking into account the overall size of the bank itself. And then from this, we're simulating any change in interest rate, the impact on overall ownership equity of the bank. Now let's provide an example. So suppose we have this characteristics. We have a balance sheet, assets are 100, liabilities are 90, therefore the capital at the minute, equity capital, would be 10. The duration of the assets is 5 years and the duration of the liabilities is 3 years. Well, first of all, there is a positive duration gap, and this is quite common given that assets in a bank or typically longer than liabilities. From that, we can work out K to be 0.9, and in the question, we're simulating a 1% change in interest rates from 10% to 11%. So now that we have all the data, we simply do this following equation. Whenever doing this by hand, please be careful with where you put the brackets. But essentially, because we had a positive duration gap, as interest rates went up by 1%, we see that the overall balance sheet fell by £2.09. So if we see in the red, what does that actually mean? Well, before we said that ownership equity would have been 10, the difference between assets and liabilities. Therefore, this means afterwards the capital's actually shrunk to £7.91. Now this is important because regulators are interested in the net worth, which is also Tier 1 regulatory capital, when it comes to working out capital requirements. So if we have a balance sheet that has a positive duration gap, then for any given change positive in interest rates, then we're likely to see regulatory capital drop. And obviously, from a regulatory point of view, this needs to be managed as banks need to hit certain regulatory requirements. So given that we have this formula, then we could arguably rearrange it to work out, well, if we want to have zero change in equity on one side, how can we reflect the numbers on the other side to ensure that equity does not drop? So let's go back and have a look at this. What could we do here to potentially make the fall not 2.09, but actually have it as 0? Now obviously it's quite hard to play around the numbers here. So in Excel, we can have a look. And if we want to get this minus 2.09 back to 0, we can potentially play around with the numbers. Now the easiest thing would do here would be to reduce this 5 to the likes of 2.7, which would instantly say the balance sheet was more immunised, given the leverage number. But in a practical sense, how easy is that to do? A bank can't just simply reduce its assets duration, because assets are longer term products. We can't just go ahead and change all that. Potentially we could have a compromise where we could potentially lower the assets but increase the duration of the liabilities. This is a little bit more practical because we can potentially issue longer dated liabilities to improve the duration on liabilities. But again, this doesn't happen overnight. And obviously if we're changing the duration of the assets or the duration of the liabilities, then this might alter the actual values or total assets or total liabilities. And if they change, then leverage changes. So the formula is a bit too dynamic. But in your own time, do have a look at this very simple formula in Excel and have a little play to see if you can change the characteristics to get the equity change to 0 to make the balance sheet more immunised. Here is a more applied example in the case of Barclays. Now the first thing to note is that the duration of the assets and liabilities has been assumed. Now if you were to do this work yourself, you could just assume something like this. However, if you have done the likes of the maturity model already, then you could use the maturity number for assets and liabilities here as well. But obviously with the caveat that the maturity model does not take into account cash flow. Rather than just stating 2 or 4 in this case, which could be extremely fictitious, if you use the equivalent numbers from the maturity model, then that might be a bit of a better proxy. But definitely caveat, the maturity model does not include cash flow. But obviously you can get the total assets from the balance sheet, you can get the total liabilities. You also know the net worth at the time of the balance sheet being produced. You can also use the current market rate or the current yield to maturity, and then from that you can simulate an interest rate change. And then using that formula, you can suggest that if interest rates move from the current market rate by 1% or whatever percentage you want to simulate, you can show the overall exposure to the bank's balance sheet. So in this case of Barclays, if the durations gap was like this, you can see that if interest rates went up, the exposure, the value of equity would drop by 22,094 million. And that equates to 2.6% of total assets, or the total assets of the bank. And for a quick recap and summary of the advantages and disadvantages of this model, the advantages is that it looks to improve both the repricing model and the maturity model by incorporating both cash flow and economic value. From an investment point of view, duration is very good for comparability between bonds of different characteristics, but some disadvantages do link to the fact it doesn't incorporate any sort of flexibility. So when we've done duration so far, we've assumed fixed products, but it doesn't assume anything that's unfixed. Could be like some callable bonds, variable products. It doesn't take into account some of the issues regarding the sources of interest rate, such as optionality. When we created this cash flow schedule, we assume that customers will not default or they may not pay back early, so none of that can be incorporated into this. When we work out price sensitivity, modified duration, I mentioned that's a straight line sort of relationship, but the concept of convexity exists. What you can see here at the bottom is the correction formula if you wanted to adjust modified duration to take into the concept of convexity to make the price sensitivity calculation more accurate. Then please do have a read of your core textbook or look up the convexity to understand how you apply the formula there. When we're talking about the likes of duration on the balance sheet, it's more about managing this duration gap rather than trying to immunize the full balance sheet, because the immunization of the balance sheet is very impractical. It could be very expensive, and like I said, traditionally assets are longer than liabilities. That's just how a bank does the transformation process and generates wealth, which we mentioned in week 1. But do acknowledge, whenever we do this calculation, I've always said that if interest rates rise by 1%, how much will equity change? We also have to consider the fact that the yield curve does not shift in parallel. So a 1% change in interest rates, that might actually shift the assets longer dated more than the interest rate would change on the shorter term liabilities. That's because the yield curve does not shift in parallel, it tilts. And we mentioned that when we covered the repricing gap. So the assumption of a whole shift in the balance sheet due to 1% change, again, is a bit of a proxy. And there is some other things that you might want to potentially think about is, what about floating rate instruments? I said you could use duration, but if interest rates change and cash flow schedule changes, optionality, default risk, what do we do with customer deposits and demand accounts? Do they get included in the model? Are they classed as fixed? Are they variable? Everything we've done so far is all about on balance sheet. What about the off balance sheet items? This is really something we're going to explore next week when we try and simulate how we could use the trading book, these derivatives off balance sheet, to potentially plug this gap. So what we acknowledged before is you could potentially restructure your balance sheet to get the equity effect to zero given an interest rate change. But that's very practically hard to do and would be very time consuming for the bank to change its whole structure. So the easier thing to do would be the likes of a macro hedge. If interest rates go up, your balance sheet goes down by 2.09, thus do something off balance sheet to raise 2.09 to plug the gap. And that's what we're going to demonstrate next week in interest rate risk management. And that concludes this week's lecture on the duration model. So now I would recommend you to go to your core textbook, do read chapter 9 of Saunders and Cornett, which explains this model and the mathematics in more detail. We do have a series of questions that we'll do in the seminar. We've got a few more examples using Excel with real bonds. You can also go to Bloomberg and have a look at the yield function on bonds, which acknowledges the duration of the bond, as well as the current yield to maturity. But then think, given that this is preferred by the BIS, then this is something I may want to be doing for my assessment. So you might want to potentially start collecting the data to do your own duration model, just like we did for Barclays, for a bank of your choosing in line with the assessment. Thank you for watching this week's lectures.